Welcome to lecture number 25. In this lecture we shall discuss about liquidity ratio. Let us start by looking at the liquidity ratios of borrowers. Liquidity ratios measure the ability of a company to meet its short-term debt obligations. The liquidity ratio measures the ability of a company to pay off its short-term liabilities when they fall due. The liquidity ratio should always be analyzed along with the operating cycle of the company to get a clearer picture of the liquidity of the company. We shall examine two ratios in the section. 1. Current ratio. It is given by the formula, current ratio equals current assets divided by current liabilities. 2. Operating cycle. The formula for calculating the operating cycle equals inventory cycle plus receivable cycle. Please note, inventory cycle is calculated as closing inventory, or average inventory amount divided by sales multiplied by 12. Similarly, the receivable cycle is given by closing receivables, or average receivables divided by sales multiplied by 12. We shall use the above ratios and analyze the working capital requirement of borrowers as part of the assessment process. Let us look at the calculation of current ratio with the help of an example. This is a very important ratio from banker's perspective, and we must note some key aspects while making the calculations. We shall begin by calculating the current assets first. Let us take the example of ABC Private Limited, a trader of cotton yarn. The company has the following financials. Inventory of 10 million rupees. Receivables, 20 million rupees. Cash and bank balance, 5 million rupees. 4 million Indian rupee loans given to group companies, repayable within 1 year. For the calculation of current assets, certain adjustments are carried out by banks. There is a difference between an accountant's current assets calculation and the banker's current asset calculation. The accountant's current asset is defined as those assets which would be realized within 1 year. In the example of MSABC Limited, as per accounting norms, the total current asset will be 39 million rupees. In this case of MSABC Limited, the banker shall make their own calculations of the current asset for a MSABC Limited. Banker's current asset is defined as those assets which would be realized within 1 year and which are required for the efficient production process. The banker shall consider some of the current assets ineligible for calculation. Please note, banker's current asset equals accountant current asset minus ineligible current assets. Ineligible current assets are those current assets which, though recoverable within 1 year but are not required for the efficient production process. Common examples would be receivable due for more than 6 months, loans and advances to group companies, encumbered liquid assets, etc. In the case of MSABC Private Limited, the banker's current assets would not include the loans and advances to group companies and the amount would be 35 million rupees only. We shall look at the calculation of current assets for the purpose of calculating current ratio, with the help of an example. The financial statement is shown in the exhibit, the balance sheet of MS XYZ Limited, as on 31st of March, 2015 and 2016. Please note the following. Inventory equals 75 lakhs. Receivables of less than 6 months equals 65 lakhs. Bill discounted equals 50 lakhs. Other current assets equals 7 lakhs. Please note, outstanding amount of bill discounting is treated as debtors and hence treated as current assets. Other current assets are any asset not linked to production process of MSXYZ and are excluded, for example loan to group companies etc. Receivables pending collection for more than 6 months are also excluded from current assets and are considered as non-current assets. Please check the figures highlighted in the balance sheet. Other current assets are: advance to supplier equals 5 lakhs. Cash and bank balance equals 2 lakhs. Thus, the total current assets as on March 31, 2015, for MSXYZ Limited equals rupees 197 lakhs. Calculating the same figures for the balance sheet as on March 31, 2016, we get the total current assets of rupees 300 lakhs. Now we shall look at the current liability calculations for the purpose of calculating the current ratio. Please refer to the exhibit showing the balance sheet of MSXYZ as on 31st of March, 2015 and 2016. Current liability consists of all liabilities which would be repayable within 1 year. This would include the following. Creditors include the suppliers to be paid within 1 year. Provisions for expenses include the provisions of expenses to be paid within 1 year. Other current liabilities include advance from customers to be adjusted within 1 year, term loan installment to be paid within 1 year, as well as any other current liabilities to be paid within 1 year. Bank borrowing for working capital. This include the cash credit or overdraft or fund-based bank borrowing for working capital. Please check the other current liabilities highlighted in the balance sheet of MSXYZ Limited. These include advances taken from customers and also maturity of long-term loans due within the next 1 year. We shall now calculate the current liabilities for XYZ Private Limited. See the balance sheet as on the 31st of March for 2015 and 2016 carefully. Let us now look at the calculation of current liabilities of MSXYZ. As on March 31, 2015, the total current liability of MSXYZ is Rs 150 lakhs. The calculation of current liabilities include creditors of Rs 30 lakhs, provisions of Rs 10 lakhs, advance from clients of Rs 10 lakhs, current maturity of term loan of Rs 15 lakhs, bank borrowing for working capital of Rs 35 lakhs. Bills discounted for Rs 50 lakhs. Please note, bill discounting is treated as outstanding bank borrowing for working capital and hence as a part of current liabilities. This was also included as part of current assets. Other current liabilities are highlighted in the current asset and liability statement of MSXYZ Limited. Thus, as on March 31, 2015, the current liability of MSXYZ is Rs 150 lakhs. Similarly, by adding up the figures from the balance sheet as on March 31, 2016, the total liability of MSXYZ is Rs 190 lakhs. We have now calculated both the current assets and the current liability of MSXYZ. Let us now calculate the current ratio for the financial year 2014-15 and 2015-16, based on the current assets and current liability figures for each year. Let us refer to the table below, showing the current ratio calculation. Please note, as on March 31, 2015, the current ratio is Rs 197 lakhs, divided by Rs 150 lakhs equals 1.31. As on March 31, 2016, the current ratio is Rs 300 lakhs, divided by Rs 190 lakhs equals 1.58. In the current example, the current ratio of the company has increased from 1.31 to 1.58 as compared to the previous year. Let us look at the interpretation of this finding, based on the calculation of current ratio, from the banker's perspective. 1. Increase in current ratio means that the current assets are financed more from long-term funds as on 31st of March 2016 compared to that on 31st of March 2015. 2. As more long-term funds are funding short-term assets, though the company will realize the amount within 1 year, it has to repay only after 1 year. So, repayment pressure on the company will be lesser. 3. Thus, if the company's current ratio has increased from last year, it means that the company's repayment pressure would be less. Hence, the lender would be looking at this change in current ratio in a favorable manner. This is a positive development. However, the cash realization part is not accounted for in this analysis. We use the concept of operating cycle to understand the same. Let us now look at the operating cycle of MSXYZ to find out the liquidity position of the company. Operating cycle implies the number of days a company takes to realize the cash from the start of the operating process. Operating cycle is calculated as the sum of the inventory cycle and the receivables cycle, as calculated and shown in the exhibit. The implication of operating cycle is, lower the operating cycle, faster is cash realization. So, if the operating cycle of the company is lower, the liquidity of the company is higher. To calculate the operating cycle, we have to calculate the inventory cycle and receivable cycle in months. The operating cycle is calculated by adding the inventory cycle and the receivable cycle. For example, if the operating cycle of a company is 90 days, it means that the company, on average, takes 90 days to realize the cash from the time it spent the amount to start the work. Usually, the company's operating cycle would be compared with the industry average. Different industries have different operating cycles. If the operating cycle of a company is higher than industry average, the position of the company is not favorable. It means that the company is realizing cash slower than other players in the industry. We shall calculate the operating cycle of MSXYZ Limited. Please refer to the balance sheet as on the 31st of March 2015 and 2016. We shall calculate the operating cycle for both the years and compare the same for assessment of liquidity. MSXYZ Limited has also achieved sales of Rs 300 lakhs, as on the 31st of March 2015 and Rs 390 lakhs as on the 31st of March 2016. We shall first calculate the inventory cycle using the formula, average balance of inventory, divided by sales, multiplied by 12. We can see from the balance sheet, the average closing balance of inventory on the 31st of March 2015 is Rs 75 lakhs. The sales are Rs 300 lakhs. Thus inventory cycle, as on 31st of March 2015 equals 75 divided by 300 multiplied by 12 equals 3 months. Similarly, from the balance sheet, for the 31st of March 2016, the inventory cycle is 3.85 months. Next, we shall calculate the receivables cycle of MSXYZ in months. From the balance sheet, we need to calculate the average or closing balance of receivables. For our example, the closing balance of receivable as of the 31st of March 2015 is Rs 75 lakhs. Similarly, on the 31st of March 2016, the receivables balance is Rs 110 lakhs. Thus, we get the receivables cycle on the 31st of March 2015 as equals Rs 75 lakhs divided by Rs 300 lakhs, multiplied by 12 months equals 3 months. For the 31st of March 2016, the receivables cycle is Rs 110 lakhs, divided by Rs 390 lakhs, multiplied by 12 months equals 3.38 months. Thus, we get the operating cycle equals inventory cycle plus receivables cycle, as on March 31st, 2015 is equal to 3 months plus 3 months equals 6 months. The operating cycle as on March 31st, 2016 equals 3.85 months plus 3.38 months equals 7.23 months. We can further segregate inventory cycle into individual component like raw material, RM, cycle, work in progress, WIP, cycle and finished goods, FG, cycle. Please refer to the table above to see the calculation of the components of the inventory cycle. From the exhibit, we can see that as on the 31st of March 2015, the inventory cycle can be calculated as RM cycle of 1.2 months plus WIP cycle of 0.6 months plus finished goods inventory cycle of 1.2 months equals 3 months. Similarly, by adding the three components of inventory cycle on the 31st of March 2016, we get 3.85 months. We shall now look at interpreting the current ratio and operating cycle of XYZ Private Limited on the 31st of March 2015 and the 31st of March 2016. The operating cycle of the company as on March 31st, 2015 was 3 months of inventory cycle plus 3 months of receivable cycle equals 6 months. March 31st, 2016 was equals 3.38 months of inventory cycle plus 3.85 months of receivable cycle equals 7.23 months. Please note the following interpretation of current ratio and operating cycle from the above calculations. In this case of MSXYZ Private Limited, the current ratio had improved from 1.31 to 1.58. But at the same time, the operating cycle of the company has also increased from 6 months to 7.23 months. The increase in operating cycle means that the company is realizing their money at a very slow pace, thereby deteriorating the cash flows available for day-to-day operations of the company. The bank may have a benchmark current ratio for each industry. Let us say the benchmark current ratio for the industry is 1.33. We have to compare the operating cycle calculated with the industry-level standard operating cycle. For this example, let us assume that the industry-level operating cycle is 5 months and 5.5 months respectively as on March 31, 2015, and March 31, 2016, respectively. Under such a situation, the company has not done well in any of the years. This is because, even though the current ratio has improved, the company is taking much longer in the realization of cash as compared to other players in the industry, and this is going up year on year. This is indicative of deterioration in performance. We shall look at the method of interpreting current ratio, CR, and operating cycle, OC, of borrower's company, from a banker's perspective. Please refer to the current ratio and operating cycle grid shown. The x-axis consists of the operating cycle figure in months and is segregated into low and high, as shown. The low and high figures shall be determined by the banker by comparing the operating cycle of the company being assessed with the industry standard figures. Similarly, on the y-axis, the current ratio numbers are indicated. The banker shall compare the borrower's current ratio with the industry standard and determine whether the ratio is high or low. Let us look at the 4 different scenarios of the combination of current ratio and operating cycle and the interpretation for the bankers in each scenario. Scenario 1. High current ratio and high operating cycle. Liquidity is low due to higher operating cycle resulting into reduced repayment capability which may offset benefits of higher current ratio. Scenario 2. Low current ratio and high operating cycle. This implies serious issues in the business, such as, indicative of seriously bad liquidity position of the company. Scenario 3. High current ratio and low operating cycle. This is the most preferable liquidity position of a company with high cash conversion rate on low repayment pressure resulting into higher repayment capability of the borrower. The banker shall consider the company's business situation favorable for extending credit. Scenario 4. Low current ratio and low operating cycle. This is an acceptable liquidity position of a company but with suitable governance supported by satisfactory track record. The company must be carefully monitored to ensure lower risk of default. Thank you for watching this lecture.